Okay, so what I'm going to do right now is I'm going to go through a complete accounting cycle for this particular example, SFG Consulting. Now, this particular consulting firm works in the auto repair industry, and they sell software to firms for inventory control. So we can look at that balance sheet, and what we need to do is initially to set up a balance sheet where all of the assets and liabilities are listed for each of the accounts. So I'm going to start ahead by indicating these categories of assets, liabilities, and equity. And often when we start an accounting problem, we put these categories so that we are sure where to enter these T accounts. And then we go ahead and we start entering T accounts. First, putting the name of the T account, and we know that cash is an asset account, so it's going to go over there. And then we go ahead and write in the balances that are on the balance sheet. And I am going to write this in thousands because I just want to save room because it's hard to write on this particular page. So I have cash accounts of 34.5, accounts receivable. That balance is 1.8. Inventory is the next one I'm going to write. That balance is 8.8. Prepaid expense, prepaid insurance, I mean, is 500. Plant and equipment is 1.3. And then we have this other accumulated depreciation, and that's a negative number, so we're going to enter it on the credit side of 0.2 on that over there. Now that is still an asset account, even though it's negative asset, it's still an asset account. On the liability side, we start with accounts payable. Now we know that what we did for assets is we entered it on the debit side. For liabilities, an increase in liability is a credit, so we're going to enter that on the credit side. Accounts payable, unearned consulting services. What this means is that we agreed to do consulting services for somebody. They paid us in advance. We owe them those consulting services, so that's why that is showing up there. Short-term notes. This balance is 0.3. And then the last liability account we have is long-term debt, and that is 7,000. On the equity side, we have invested capital, which is initially sales of stock for the owners of the firm, and this is 5. Retained earnings. This is when a company makes money. They keep that money in the bank account, in their accounts, or they distribute it to their owners. In this case, this is the amount that they kept. They distribute it through dividends. This is the amount they kept. Okay, so now we've recorded all of these balances. Let's go ahead and actually start recording the transactions now. So the first transaction says the firm received $1,000 payment on accounts receivable. So sometimes it's best to think about the effect on cash. So the effect on cash is if we received a payment, that means it increased cash. Cash is an asset. An increase in an asset is a debit entry. So I'm going to put $1,000 right there. But I'm not going to pay another side of that. So it says we got $1,000, which is a payment on accounts receivable. So somebody who owed us money no longer owes that. So it's a decrease in accounts receivable, $1,000 there. So just to be sure, what we did is we had this account, this value, that $1,000 equaled that debit and that credit. And we want to always make sure we're doing that when we're recording transactions. Okay, so the next transaction is the firm got a new long-term loan for $1,000. So we know it's long-term debt here. So we're going to put $1,000 there. And then a loan, when we get a loan, actually the effect of a loan, it seems strange, but it's actually that we get more cash. We have more cash in our cash account. So we're going to go ahead and enter that. One credit entry and one debit entry. One debit entry and one credit entry. Oops. Make sure I put that one there so I don't lose it. Okay, the next one. The company purchases a new set of tools for training purposes for $1,000 cash. So we use some of our cash, so that's a decrease in our asset. So we're going to put it here. And we bought tools. The tools are going to last 5 years, it says there. So those are long-term assets. This would be equipment. We're going to put that value in the plant and equipment. The next one, number 4, says the firm purchased 12 new software packages for inventory at $100 each, cash. So we used some of our cash and we bought some inventory. So using cash decreases it. So we're going to have a 1.2 decrease in cash and a 1.2 increase in inventory, which is a debit entry. And the next one is the firm paid $2,000 that it owed to suppliers. So we took some of our cash and we paid back what we owed to our suppliers. Decrease in cash of $2,000, decrease in accounts payable of $2,000. Then the next one, the firm paid $100 on short-term notes. So what we did is we took $100, 0.1, and we decreased our short-term notes. Decrease is a debit entry in liability. The last one is the firm issued 1,000 shares of stock for $10 each. When you issue stock, what happens is you sell pieces of paper to the public, and they now are part owners in your firm. So the ownership of the firm went up $1,000, so we have a ownership or an equity increase of $1,000, which is a credit entry, and we also got $1,000 cash. That completes all of our transactions. The next thing we do whenever we are done doing transactions for a particular period of time is we go ahead and draw lines indicating that we're closing these accounts. And then we do totals on this. So I'm just going to start here, 19.4, that one did not change. 6, 8, this one actually had a decrease of 0.1. There was no change in consulting services. This one, now the balance is 10. No change in depreciation. Sorry, I have a funny one there. This one went to 2.3, plant and equipment. No change in prepaid insurance. Inventory went to 10. Accounts receivable went to 0.8. So you can see that I'm entering it on the larger size so that it actually includes that amount. Okay, so it's a little bit more difficult on this side, but I think this is 33.2. I hope that's right. Okay, now one of the things we do to check, because when you're doing accounting, if you've made a mistake, it can get you so messed up. In fact, you don't know, but this is the second time I've done this video because I made a mistake. I hope I didn't make a mistake this time. But the way I do, what I want to check about that is I want to write down all of the debits and make sure they're equal to all of the credits. So the debits are the things on the left-hand side. So I have 33.3. I have a 33.2, if I can write. I have a 0.8. I have 10. I have a 0.5 and a 2.3. So that totals to 8. On the credit side then, I have a 0.2 for that accumulated depreciation, 10 for accounts payable, 3 for unearned consulting services, 0.2 for short-term debt, 8 for long-term debt, 6 for invested capital, and 19.4 for that equals that, and I'm so happy. So now I can I'm actually completed all the transactions. I've recorded them all. And that will stop there. What we would then do is create a balance sheet, but I want to go ahead and stop this right now. Okay, thanks.